The ECB is central bank of a region that is stagnating at best and maybe sliding into recession or a growth recession. So they are going to be looser. They're going to cut rates. They're going to resume asset purchases, the lot. This is a very different position from what Powell is in, where the economy still, despite slowing down a bit, still has a lot of oomph. I mean, consumer spending, which is 68% of GDP, is healthy. You get 224K payroll. That's not sort of alarm time. So they are in very different boxes.
But at the same time, Powell also doesn't want to let himself or our central bank get too far away from the rest of the world, which is still so easy.
No, absolutely. I think there will be due consideration given to the need to act in a more sort of in a looser way, either by ending asset purchases, asset sales earlier, or by cutting rates. But we have the view that it is still early days for the US, that this month, sort of July, well, we're getting closer to the moment of truth, won't be the moment at which rates are cut.
Is there any question in your mind that independent Federal Reserve policy is the way to go, that is the preferred way? Or can there, in fact, be a case to be made that perhaps monetary policy should become a little bit more political?
Well, it should be operationally independent. Clearly, the objectives of monetary policy are set by politics, by the Federal Reserve Act, maximum employment and stable prices. So that is political. But given these objectives, the implementation should be basically a technocratic exercise. And that is the right division of labor. And I very much hope and expect that we will stay there in this country too.
What do you make of the whole argument that you just said it yourself? Our economy's good. The stock market is at an all-time high. Access to capital is incredibly easy, as it's been for the last handfuls of years. Why in the world should you cut interest rates in that kind of environment?
This is an excellent question, which is why we believe that it is unlikely that we will see a cut as early as July. But the economy is slowing down. There are external risks, and you have to not just look at where the economy is, but where expected to be going. So a long view, taking into account the negative impulses from trade wars and related issues abroad, could drive you to cut rates even when the domestic economy is still humming along pretty reasonably well. But we don't think it's the time this month.
In this world, though, of such low interest rates around the world, we are in an environment where more than a quarter of the world's sovereign debt is negative yielding. And we're in a situation in Europe now where there are now, if you can believe, 14 European corporate junk issues that have negative yields.
Oh, yeah.
Negative yields right now, and that is up from 0 at the beginning of this year. What does that tell you about investors' trust in banks and the need to put their money into a negative yielding junk issue?
This is crazy times, right?
Yeah.
And we have to get used to it, unfortunately, because it will last. It's not going to go away. In Europe, certainly, and in Japan, yields close to 0 or in negative territory are going to be the norm for at least several more years to come. Fortunately, the US doesn't suffer from that particular malfunction. Rates are low here, but not negative. So, but just be prepared for the idiocy of the liquidity trap.